Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, for your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. We've got Chuck with us again today. We're really excited because we're going to talk about lifting weights while you wait. I don't really understand what's going on here. We're a little pre-game talk that I know all of you know that we have, and they're talking about like dumbbells and weightlifting and things going on. So we're going to dive into all sorts of stuff, and you might actually be physically stronger when we get done with the show today. Mark, Chuck, who's taking it over?
It was beautiful, wasn't it, Mark?
Probably Chuck. Chuck's a lot bigger than me.
Okay. Well, Matt, I know why. That's why you're the best in the business. That was right off the cuff. That was so accurate, though. I'll give you a little color on how we're going to put this whole thing together. So we have this acronym, the word WAIT, right? Our theme for the year. It's investors need to be patient. The first three letters are these headwinds, right? Washington, A's accommodation for the Fed, I's inflation, and T's ultimately this technological revolution that's going to take hold at some point. But waiting is really probably an anathema to most people's thinking, right? Especially in the United States. Those of us who are type A personalities hate to wait. So I also want you to think about it this way. So when you have an athlete, right, that's off season, right? They're not just sitting around on the couch, right? They're getting ready for the next season and they're training. So weightlifting is a part of training. So what we want to get across is, yeah, our firm is waiting for things to pan out, the Fed to finally finish a year and a half around their rate hikes. Where's inflation going to go? What's going to happen with the midterm elections? But we're not just sitting on the couch. We're making changes. Mark, you and I talked about this morning, right? I'm 2 hours earlier than you, or behind you, I should say. And I get this text, I think it was 6:30 in the morning. Hey, I'm making changes XYZ. So we're like off-season athletes, Matt, that, yeah, we're waiting for some things to happen, but we're certainly not sitting around. We're out executing strategy and looking for great companies on sale. So how do you like that, Mark? Was that a good lead in for you, my friend?
That's a perfect lead in. Well, here's what we started telling our clients late last year, early this year. Don't expect big returns in 2022. 19, 20, and 21 were great.
Yeah.
Values of businesses, notice I say values of businesses and not the quote unquote stock market. Values of businesses do not go straight up. And unfortunately, many investors have a short-term mindset about their investments. And so they end up wanting, needing, hoping for immediate gratification. This is why we tell all of our clients, it's written in our investment policy statement, if you're a growth investor, your time frame has to be 7 to 10 years.
Exactly.
Now, markets go up, markets go down. Values of businesses go up, values of businesses go down. But after 3 years of great returns, we have told our advisors and our clients, don't expect much out of 2022. Now, could we be wrong? Of course. I hope I am. I hope we're up over 20% again. But the way things are playing out, the way we have discussed what's happening economically and with valuations, it would be better to be looking at how you reposition your portfolio coming into this and coming out of it. And we've talked amply about how we repositioned portfolios coming into this year. And that process started 18 months ago. This is why we tell investors investing is a long-term process. It is process before progress. And we have already made a lot of the adjustments, frankly, this year in the first quarter, after a dismal first quarter. We've already made a lot of the adjustments to prepare us for 2023 and what we think is going to happen there, and repositioning the portfolios for more growth in 2023. And we've already made those changes in the first quarter
of 2022.
Exactly. So we are in training continually, even when you're in season and out of season. You're always training. You're always tweaking. You're always fine tuning the portfolio, i.e. your body, right?
Right.
When you want to stay in shape or be an athlete in a professional sport. So you are dead on in your comments.
Hey, thanks, Mark. And I'm going to bring in this, and I think Matt said it in the opening line, lifting weights, right? Dumbbells, barbells. Here's the barbell strategy. So if I can, Mark, I'm going to read the definition as it stands on Investopedia, which for people who don't know, that's the investing version of Wikipedia. And I want to talk about, because you just nailed this, I think. If everyone can picture a 100-pound barbell set, right, where you got a bar that maybe weighs, let's say 34 pounds, and then you have two existing set of plates on each side that weigh 33, right? So you got 100, they're equally dispersed. So here's what this barbell strategy is. The barbell strategy is an investment concept that suggests the best way to strike a balance between reward and risk is to invest in the two extremes of assets while avoiding middle of the road choices. So let's go back in time, Mark. And I remember this because 2 years ago, almost to the day, oil was trading negatively for a day and a half, right? And
Yes.
who would have ever thought that you're going to go in and buy energy companies right in the midst of a pandemic when no one was doing anything, and walk through some of those companies that you bought a year and a half ago, 2 years ago, to now? The crazy thing is, who would ever buy some of these tech stocks that have sold off 30 or 40%? And that's this two extremes. So I want you to talk about those, if you could, if people can picture this barbell in front of them.
Yeah. So my theory, my thought process at the time was that as you come out of COVID, the economy is going to heat up, and it's going to heat up fast, because just as fast as the economy slowed down and you went into a recession, it was a single event that was going to eventually pass. And when that event passed, your economy would open up relatively quickly and you'd have massive pent up demand. This is even before I realized or thought that the government was going to stimulate that by giving a bunch of money into the economy. So you have a quick recession. It quickly has come out of that recession. The economy has been growing tremendously. And you got people with a lot of money because the government stimulated to keep the economy going while things were pent up. At that time, what I felt, and I still believe this today, and it's panning out that way, is that when you put so much liquidity in the system to help the economy grow, eventually that liquidity has to dry up. Eventually the government has to take that off.
Right.
And I think what would be shocking for many people listening to this podcast to realize is that, it's April, 11th, 2022, and the 10-year is trading today at about 2.74?
Yeah, just a little above it, almost below 2 point, just below 2.8.
Okay, so it's gone from 50 basis points at the bottom to 2.75. So
Right.
A lot of investors in the first quarter today are saying, holy cow, I've lost a bunch of money. My bond funds have lost money. I've got a negative return on my bond funds. I didn't think you could lose money on bonds. One of the most common comments of investors. I didn't know you could lose money in bonds. Oh yeah, you can, and you can lose a lot. Now, at the same time, as you've seen the 10-year go from 50 basis points to 2.75, it's still 10-year is still not where it was in 2019 before COVID. And I think a lot of people forget what interest rates were and how well the economy was doing when it went in free fall. So we've been bearish on bonds for probably about 6 or 7 years, extremely bearish at 50 basis points. I just felt, bonds have never been, interest rates have never been this low. This economy opens up. You're going to want to own stuff that's going to be interest rate sensitive. You're going to want to own things that have pricing power. You can raise your prices in a rising interest rate environment, i.e. inflationary environment. And lo and behold, that's where we're at right now. And I think that a lot of people have been caught off guard. This is why we really by the end of 2021 and quite a bit before that, we're out of all but maybe 4 of what I would refer to as quote unquote growth stocks. And we're more in an allocation that benefits from higher interest rates, benefits from inflation,
Right.
and benefits you in an economy that is going to continue to expand. We are not in the camp of a recession. Still are not in the camp of a recession. Everyone talks about recession and no one talks about the pent-up demand anymore all of a sudden.
Hey, do you guys mind if I just jump in here and ask a quick question? Because
Yeah.
I don't normally do this when you two are riffing, but Mark, you just said something there. And Chuck, I'd like for you to expand on this a little bit. Is the idea that people didn't think they could lose money in bonds, right? Which in modern portfolio theory, right, you've got the balanced, and I'm air quoting their portfolio. And if you've got upwards of 50, 60, 40, 50, 60% of your assets allocated to bonds because that's safer, isn't that scary? We're talking about
why I don't like it.
Well, I know, and we've talked about that a lot, Mark, but as we are, expanding the audience of this is still something that is a closely held belief by a lot of people who don't have your level of clarity with investment.
Well, a lot of those guys, a lot of financial advisors, their main statement is you got to ride it out. We're long-term investors.
Yeah.
We're long-term. You got to ride it out. We're long-term. How many people listen to this podcast and said, hey, we're long-term. We're long-term. Yeah, we are too. But in the midst of events, there is always opportunity. So you can be long-term, but as we discussed at the beginning of this podcast, you can be in off season, i.e. a market not going up or an economy not doing well, and you can be training for that next season, i.e. when the economy does better. People don't even understand how bonds work. They just think you should own bonds because that's what modern portfolio theory says. In other words, modern portfolio theory really places itself in this idea that volatility is bad and that owning bonds reduces the volatility in your portfolio. Well, if you're long-term, you're long-term, as modern portfolio theory says. Therefore, why should you be worried about volatility? So you shouldn't be worried about volatility, yet you should use modern portfolio theory to reduce volatility, and you should buy it, hold, and stick to the long term.
Oh my goodness, that was so good. I didn't know you were going to go that way. That was genius.
Call that common sense.
Yeah, I think you're right.
Our most conservative portfolios right now are pretty much flat, maybe up a little bit this year. Now think about that.
Yeah. And the average conservative portfolio, Mark, think about this, is down 7%. It's down more than the S&P 500. That's a 20-80 portfolio, 20 stocks, 80% bonds because of what Matt just asked.
Yeah.
It's an incredible dynamic. And we've had a 40-year bond bull market, basically, right? From the 20%er, right? And now all of a sudden it's going back to normal, we believe. And maybe bonds, they probably aren't going to be that asset class of choice to, suppress volatility.
Well, you can buy great stocks to reduce volatility.
Yes, you can.
So there are other ways to reduce volatility without owning bonds. And that's number one. Number two, we haven't lived in a world of a secular bear market in bonds. We've lived in cyclical bear markets in bonds, but we've been in a 40-year secular bull market, and most investors today don't understand how that really works. Now, that's number one. Number two, you heard me say this 1,000 times. I'm going to say it again for the listeners. Risk is relative. Risk is not absolute. Risk is not linear in nature. Risk has variables. And the more you understand the risks in your portfolio, the more you understand the opportunities set forth for yourself as well. And look, here's what I think is going to happen. This may throw you a curveball a little bit here, Chuck, but here's what I think is going to happen. I think that more than likely at the end of the day, we're not in the business of predicting, so we may end up deleting this podcast, Matt, sometime down the road. I really believe that people have been more bearish about the idea of a recession and that the Feds are going to raise interest rates way more than they really will. And there's always a balance. And there's going to come a point where people are going to say some of these long-term great companies are going to do well. Now, I'm not saying this happens all the time, but take a look at a company like Square today. Square is up a little bit, and the NASDAQ is down over 2%. There are growth names that are up today. Not many in certain areas.
Yep.
Because risk is relative. And you never want to look at the performance or the action, if you will. They call it price action of the companies you own on a daily basis. When you invest in a business, your timeline is years. So if we're wrong and these stocks go down some more, guess what? We're going to buy some more. That's why volatility is good. And if your allocation is appropriately set for the volatility you're experiencing in your portfolio, then why worry about the noise and everything that's going on with your portfolio?
You certainly wouldn't. And I think that's why our process is so prolific. I'd like you to talk a little bit about Mark. I got, Mark and I are texting each other back early this morning, and we don't have to mention the name of a company, but there are sometimes companies that unfortunately get held up by the perception of what their business model is, right? If it's tied to COVID vaccines and those particular companies aren't trading very well. Talking about the flexibility where, hey, I can buy this based on the assumption that it's going to be viewed in this way. And then all of a sudden, something does change. That's why this staying in shape, using this strategy, I think, allows us to pivot and talk a little bit about that. I don't know if you want to mention the companies, maybe you don't have to, but you know what I'm referencing, right?
Right. Well, look, it's bigger than that. Remember, we're a top-down, bottom-up. We have 4 sell disciplines. One of our sell disciplines is you may like the company, which I do in this case, but the better opportunities have presented themselves. When you invest in 20 to 30 companies in your portfolio or 35 companies in your portfolio, you can afford to be picky. You can afford to be choosy in your asset allocation. And when you have a market like we have right now, where you have valuations of the businesses flying all over the place in the short term, the reality is 5 years from now, this correction we've been going through the last, call it frankly, almost a year, believe it or not, will be a blip on the screen. And so when you get into what I would refer to as the latter stages or the bottoming process of a correction, you want to make sure you own the best of the best companies.
Exactly.
And one of our sell disciplines is you sell a company because you have found a better opportunity based on what's happening in the markets and the economy today. And that's why we've sold this position. It's a minor tweak to the portfolio, but it is positioning the portfolio for the next 3 to 5 years out.
So very well said. And it's almost like when you think about how people view, what you say, a portfolio, it almost seems to be there's these extremes, meaning it's either one or the other. And what I love about the way it looks today is you can have a grouping of top-notch energy companies, top-notch financials, whether they're banks or property and casualty insurance companies. Yet on the other side, you can have tech stocks that are either going to be on the cutting edge of something like Web 3.0, or maybe have a proprietary technology that
Web
is
3.0, by the way, just to clarify. I think you said Web point.
What did I say?
Something like that.
I thought I said Web 3.
That's all right.
Okay. All right. Well, thank you for correcting me. Matt usually does that, but that's okay.
Clarifying.
Web 3.0. Sorry about that. And so here we have, again, this barbell mix of companies that supposedly do really well in an inflationary environment, rising rate environment. Yet on the other side, we're owning these tech companies that the news media, the financial news media says, well, you should totally be out of those. They don't work in this environment. And so you're holding those companies that you chose a year and a half ago, still doing well, but again, positioning for the future by owning some of those great tech and growth companies. That's what I was hoping that you could maybe unpack for us here.
Yeah. When we make investment decisions, we make them for the next 3, 5, 10 years, not the next 1 year. It's not uncommon for, the economy to go through a recession or have a slowdown period, but that doesn't mean you just go and sell everything. It means it is like your weightlifting / off-season training.
Yeah.
In off-season training, i.e. in years when the markets are down or flat, it doesn't mean you quit. It doesn't mean you just sit there and wait for the next year.
Here you go.
What you're doing is you're tweaking. You're modifying for people who exercise, how many times have people modified their workout, modified their diet?
Yeah.
You got to modify your portfolio, and you constantly are tweaking it, just like an exercise, a workout regimen. And that's all we're doing. And look, we told clients, you're up X percent. It was a great 3 years for our clients. That's great. But we got new clients coming in all the time. What's the story we're telling them?
Yes.
Same story we're telling the people that had the great last 3 years. It's sticking to the process. Our process says this. In our process, we do that. And we invest in businesses for the long term. Right now, our growth portfolios are probably down before today, because the markets are down pretty big today. So I got to look. But before today started, our growth clients were down about 1%, 5 to 6 percentage points better than the S&P. Obviously our balanced, we're flat to up a little bit. Yada. That's all great short term. The whole point though is it doesn't matter how poorly you're doing at any given time. And it doesn't matter how well you are doing at any given time. You are always tweaking. You are always exercising. You could be the best athlete in the world and you could be the strongest, but that doesn't mean you quit your exercise regimen. You stick to your process and you continue to modify where needed. You pull a muscle. What do? You modify your workout. You get a bad stock. What do? You assess. Maybe you sell it. Maybe you buy more. You modify it. The analogy of weightlifting and exercise is perfect for what you do when it comes to managing your portfolio.
Mark, that was just beautiful. You unpacked it so well, because what I was thinking of, and if there's any financial advisors that would ever listen to this or could hopefully listen, is the opposite is when you do give up and you say, my goodness, this is a down year. There's nothing we can really do. I'm just going to sit back and just let this thing ride itself out and just hold my hand to my client and hope that they don't leave or they see through the ruse, if you will. And I what you just nailed was exactly what I was hoping. What I was thinking of, and both you and Matt probably remember the great wide receiver, Jerry Rice, and what he used to do in his off-season training. And he'd get into a football stadium. Of course, no one was there, and he'd be running up and down, right, the steps. And here was a guy that you wouldn't think wouldn't need to do that, or Larry Bird, right, just shooting 3-pointers for 4 hours off season. So the great ones do that. They're never sitting back and kicking the feet up, right? It's always, hey, look, where's the next great company I can find? When can I buy it on sale? Where can I pare back something that I own that's done really well?
And they never sulk when they make a mistake. When
exactly.
Decision, we don't sulk over it. We sell it and we move on. It's all about the process. It's sticking to your process before progress, as we've said. And just like an athlete, just like anyone who has a routine that has been successful, a process, there's always modifying, there's always adjusting, but you never give up on the process. And that's what we continue to do, even in what's happening today.
I love it. What do you think, Matt? Do you think you hit another home run today, Mr.
I do.
Pearson?
So I have, we've been doing this for a long time, guys. And honestly, I've used the analogy before, like Michael Jordan, shooting free throws and, all of that offseason stuff. but I never really put the pieces together like I think, Mark, you just did. Because why people want to work with Nepsis is because you are that level of professional. You are the one that shows up every day. You are the one who practice off season. You're always in your craft. You're always learning new things. And when you do make a mistake, you fail forward because you want to get better in the future. For those of you who are listening who don't have a money manager, an investment manager who is at that level of professionalism, I think that you're really, truly missing out.
Well, thank you.
You're welcome.
Appreciate that.
Touche, as one of our great friends would say, right, Mark?
Yes, sir.
Yeah.
All right, everybody. With that, you need to share these podcasts with your friends and family. If you have not done that yet, all you have to do is click that share button. It's very easy to go ahead and share this with the masses so that they can truly find out how to invest with clarity. If you personally have not subscribed to the show, please click that subscribe now button. And of course, you just need to pay attention because these are coming out fast and furious and with great information that will help you truly invest with clarity. So for Mark and Chuck, this is Matt Halloran. We'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.